All right, welcome to this 8th video in this series where we are building a fictitious company from scratch, following this company through a series of transactions, learning how to book the journal entries for those transactions, seeing how that wraps up into our general ledger, and how the general ledger is used to build the financial statements. And remember, the financial statements is what the company uses to understand how the company is performing. In this video specifically, we're going to take a look at how you record the cost of goods sold for when you sell inventory. Now, if you have not seen the previous videos, I highly recommend you do that, especially the first video, because in that video, I show you where to download the Excel workbook for this course. And you're going to need this Excel workbook to really follow along with this course and to get the most out of this course, as well as to really understand how journal entries work, how those journal entries funnel to the general ledger, and how the general ledger is used to build the financial statements. And ultimately, that's what we're trying to get to in accounting, is to get that information up to the financial statements so that the business can understand how their company is performing financially. So, assuming that you have done that, let's get into this video. All right, I'm looking at my computer screen now, and if you remember in the previous video, we made our first sale, right? Let's just quickly recap what we did. We sold 30,000 mugs at $2.50 per mug to a customer with terms. So we sold it on credit. We didn't get cash right away for it, but we recorded a receivable for that sale. Now, the only part of that transaction that we recorded was to record the sale. And if you remember, 30,000 mugs at $2.50 per mug comes out to $75,000. So one side of that journal entry was to record the asset, the receivable that says, hey, we still need to collect the cash on this sale, but we also recorded the revenue piece, say, hey, we have now created revenue. We've created a sale in this company. Now that's one side of this event, The other side of this event is to record the cost of this sale. Now the cost of this sale is the cost of the inventory to us that we sold in that transaction. So let's take a look at this now. So it's the same day here. We had this journal entry. I'll scroll over here. Just zoom in a little bit. It's the exact same entry, but if you remember in the last video, we just recorded the sale. Now taking that exact same financial event, we're now going to record the cost of goods sold. So basically, to recap, before we get into this journal entry, let's take a look. Let's kind of recap what we did. Let's first start with the general ledger. You remember in one video, we purchased inventory, right? We purchased $25,000 of inventory. Now that inventory sits on our balance sheet as of today because we haven't sold anything. Now, if you remember in the previous video, we made the sale. So on our income statement, we're now showing that we have $75,000 of revenue, but these financial statements are not complete because they don't show the cost that is related to that sale. And that's what we are going to record in this video. So now let's go to our journal entry. Let's put in the same post date, 12/01/2020. And now remember, remember that we bought inventory, right? And if you remember, when we purchased that inventory, we had to debit our inventory to increase that asset. So we're definitely going to be dealing with an inventory account. And I'll put in here, kind of just put up here, 30K units sold to Coffee World. That's just my memo for the transaction. Now the question is, what's the debit? How do we calculate what the cost is? So if you remember in a previous lesson, when we actually recorded the sale of the inventory, we also recorded a schedule where we could track the cost of that inventory. Remember, we bought 50,000 units at 50 cents per unit, and we recorded the journal entry to increase inventory in our company. So the cost per unit to us is 50 cents per unit. So now we can go to our general ledger account, our journal entry tab, and we can calculate. Now, inventory, when we buy inventory, when our inventory increase, it's a debit. But when we decrease an asset, such as inventory is an asset. When we decrease this asset, it's going to be a credit. So let's go ahead now and record this credit. And I'm just going to put a formula base so you can see what I'm doing. It was 30,000 units, and the cost per unit to us is 50 cents. Okay, so the cost of this sale to us is $15,000. Now we will record the other side of this. And real quick, before we record this, so we can just see what's happening, if we go to our balance sheet right now, we can see our inventory went from $25,000 now down to $10,000. We can see that on the general ledger as well. We had $25,000. We now credit it for $15,000 in the sale, and now we have a balance of $10,000. But we have to finish booking the other side of this. So we are going to book now the cost of goods sold, right? If we go to our general ledger, we have all our general ledger accounts over here. We have the categories that they're in. We have our revenue accounts, and now we have our expense accounts. And one of the expense accounts is the cost of goods sold, which represents the cost of the inventory that is sold. So let's now finish this. We have cost of goods sold. I will copy the memo from above. And now you might be saying, okay, it's a cost, it's an expense. Why do we debit it? Okay, accounting is like a language. It's just a system. It's better to just memorize the system. And as you go along your journey in learning accounting, the more journal entries that you book, it will just be like speaking another language. But in case you weren't sure, go to this cheat sheet. And right here, we have expenses. And when expenses increase, it's a debit. So we have zero cost of goods sold. After this transaction, we're going to have, what is it? What is the, oh, 15,000. We're going to have $15,000 of cost of goods sold for this period. So it's going to be an increase. And so an increase in an expense account is going to be a debit. So we're going to go ahead and finish this journal entry right now. And there we go. Now we have a completed journal entry. And now what we can do is we'll real quickly just take a look at the general ledger. We already saw the impact to our inventory right here. We saw that we had 25,000. We now credit it, and now our balance for inventory after this transaction is $10,000. Now if we go down here to our cost of goods sold, we now see that we have a cost of goods sold of $15,000. And now we can actually look at our income statement and see what the gross profit from that sale was. So in the previous video, we recorded the $75,000 of revenue. And in order for that event to be complete, we had to also record the cost related to that sale. And that was $15,000. So revenue, subtract the cost of goods, the cost of those inventory sold, now gives us our gross profit or our gross margin. And our gross margin now in the business is $60,000. Let's quickly take a look at our balance sheet. We already saw that inventory went down. We're holding inventory at $10,000. Our total assets right now is $210,000. And our liabilities and shareholders' equity is also $210,000. And you might be wondering, how is that working? How does that work? Well, you have to remember that one part of when you look at the liabilities and shareholders' equity, one, you have the change in the liabilities accounts and equities accounts, but one component of equity is your retained earnings, and specifically it's the year-to-date net income, right? So this $60,000 that gets pulled into the balance sheet is coming right here from the income statement. And that's when you plug that in. If we didn't have that, our balance sheet wouldn't work. But you have to include your retained earnings, your earnings to date, in order for your balance sheet to tie out, which means your total assets is going to equal your total liabilities plus shareholders' equity. Now, the last piece of this is we need to update our schedules. So the only schedule we need to update is our inventory schedule, because we're only keeping schedules for our balance sheet accounts, and our balance sheet accounts are going to be all of these: your assets, your liabilities, and your equity. We're just not doing equity right now, but these are essentially your balance sheet accounts when I refer to balance sheet accounts. And when I refer to income statement accounts, this is what I'm referring to: all your revenue and all your expense accounts. So let's update our inventory schedule now for this transaction so we can track it. So here it is. Now I'll put the same SKU, put the name, what we sold, and the transaction type now is we shipped. We shipped 30,000 units, and we shipped that on 12/01/2020. The quantity, I think, let's see, I need to put it as a negative 30,000. The standard cost was 50, and there it goes. So we're now showing this transaction in our inventory subledger. And you can see now that the total balance in this subledger is $10,000, and that agrees to our general ledger. So now we have a schedule that reconciles to our general ledger. All right, that's the video. I hope you enjoyed it. I hope you're starting to understand. If it was confusing and I talked too fast and I kind of just ran through things, don't worry. Maybe try watching it again, but really, you're really going to pick this up the more we do. And my goal for you is by the end of this course that you will fully understand how to do this on your own. All right, thanks for watching. See you in the next video. All right, bye.